Twitter's stock declined 21% on Friday. Even though Twitter has 187 million active users, that's lower than analysts' expectations of 195 million. Twitter's earnings were 4 cents per share in the third quarter of 2020. That's down 22% from the year prior. Let's look at this stock a little closer to figure out whether it's a buy or a sell. Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing Twitter's stock by analyzing their financial ratios and dissecting their financial statements so we can determine if the stock is a buy or a sell. Twitter is a microblogging and social networking service where users post and interact with tweets. Registered users can post, like, and retweet tweets, but unregistered users can only read them. It has 25 offices around the world. Tweets were originally restricted to 140 characters, but was doubled to 280 for non-CJK languages in 2017. CJK means Chinese, Japanese, and Korean. Audio and video tweets are limited to 140 seconds. Twitter was created in 2006. By 2012, more than 100 million users posted 340 million tweets a day. Let's get started with the model. This is a large cap company, 32.7 billion market cap. That's the value of the company according to the stock market. They're trading at $41.36 a share, and they have 791 million shares outstanding. Let's look at their financials. Free cash flow, that's how you value a company. You estimate the future free cash flows, and then you discount that number back to today's value. That's what we're doing in this video today. And free cash flow is cash flow from operations minus capital expenditures. So if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things unless it takes on more debt. And this company has positive and healthy free cash flow each year, which looks really good. Net income is a profit and loss on the income statement. It's revenue minus expenses. And they have negative net income in 2016 and 2017. Their revenue looks really good. It grows from $2.5 billion in 2016 and way up to $3.5 billion in 2019. So they're moving in the right direction. In 2019, they had $3.5 billion of revenue. $3 billion was from advertising and $500 million was from licensing. So you can see advertising is such an important part of their business. This is the company's income statement, and let's see why they had negative net income in 2016 and 2017. So you can see in 2016, top line revenue of $2.5 billion, but their operating income was negative $367 million, so they had more expenses than revenue. They were even worse in 2015 at negative $450 million, but you can see in 2017 they did squeak out a small operating profit, much bigger in 2018 and 2019. In 2017, although they had positive $38 million of operating profit, they still had to pay interest on their debt, which is $105 million. So that brought their net income to negative. This is a statement of cash flows, and operating cash flow is a better indicator of a company's health because operating cash flow takes net income, then it adds back the non-cash items from the income statement, and it also adjusts for changes in working capital. And the company has positive operating cash flow in all the 4 years. And the way you calculate free cash flow, it's operating cash flow minus CapEx. So each year they did have positive and healthy free cash flow. Let's look at the capital structure. $2.5 billion of debt, $8.7 billion of equity. They pay 5.5% interest on their debt, and 22% of the capital structure is debt, which means 78% is equity. The cost of equity is 8.5%, and to calculate cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta. That's how volatile the stock is relative to the market. And their beta is 0.81, so the stock is less volatile than the market. And their WACC is 7.86%, which is a blend of the cost of debt and cost of equity. And that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year for that $16 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $14.4 billion. We divide that by 791 million shares. we calculated $18.24. They're trading at $41.36, so they're trading at a 127% premium. It's a sell according to the model. Simply Wall Street's at $26.92, so they're also saying the stock is overvalued, just not as much as me. Let's see where the stock has been trading the past few years. A few years ago it was trading in the 20s. Then the price was driven up over $40, but it's come back down. It looks like the stock price peaked this month, but it's come back down a little bit. So it still seems like an overvalued stock, at least according to my model and according to Simply Wall Street. If you invested $100 in Twitter in December 2014, you'd have a little less than $100 today. If you compare that to the S&P 500, they're doing much better than Twitter, and the Dow Jones is doing the best among the three. Twitter has never paid a dividend, and it probably will never pay a dividend. If you invested $10,000 in Twitter when it IPO'd in 2013, you'd have $9,200 today, about an 8% loss. The next few slides I pulled from the company's 10K. The graph on top shows the average users by quarter, and you can see it's growing each quarter. This is worldwide. The bottom left is just the American users, and you can see it was flat for a few quarters, but then uptick a little bit the next few quarters. According to this chart, their international users are growing much faster than the American users. Twitter is doing a great job at getting users to engage with ads. You can see the percent change by quarter, 69%, 81%. Even these smaller numbers, this is just a change over the prior quarter. Although it is a little concerning that the cost per ad is decreasing each quarter. The next 6 charts are related to the risks associated with the company. Twitter says if we fail to increase our MDAU, this is a common term the company uses in its 10K. I wrote out the meaning up here, monetizable daily active users. So if the company fails to increase MDAU, ad engagement, this is a really important part of their business because that's how they generate money, from ad engagement. The top thing Twitter mentions is influential accounts contributing unique and engaging content. They also mention other factors like if they're unable to convince people of the usefulness of their product and services, if there is a decrease in the perceived quality, usefulness, or trustworthiness of the site, and of course things like data breaches and privacy concerns. So obviously users are so important to the site, but if they don't have advertisers, they won't make any money. So the company must continuously add new advertisers and encourage existing advertisers to maintain or increase the amount of their advertising budget. Of course, there's vast competition with other websites and apps. Here Twitter mentions if we are unable to compete effectively, our business and operating results could be harmed. There are so many other options for people to go to: Facebook, Instagram, Google, YouTube, Snap, TikTok. Twitter constantly has to stay ahead of the curve and attract customers to its website, as opposed to going to other sites. Twitter mentions regulatory investigations and settlements could cause us to incur additional expenses. There are constantly data breaches that Twitter has to contend with. Twitter is spending tons of money to maintain its security setting. It mentions in the past we have incurred significant operating losses. We talked about this earlier when we noticed those large operating losses in prior years. Although it was good to see Twitter had significant operating income in 2019 and 2018. But of course that could always change in the future. This statement is true for any stock, but Twitter mentions it in the 10K. If securities or industry analysts change their recommendations regarding our common stock adversely, the price of our common stock and trading volume could decline. If a company is reporting great financials, but an analyst changes their view from a buy to a sell, then investors may just sell their stock and not buy it and drive the price down. It's good to remember that a company's financial performance is not 100% correlated to the changes in the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if there are more buyers than sellers. The stock price will go down if there are more sellers than buyers. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and its stock price keeps going up. The market is forward thinking. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest things to figure out. In the short run, no one can predict the stock market, but if you invest in solid companies with good fundamentals and hold long term, you should be better off than most investors. The reason I like focusing on financials is because all the information is there. If you listen to others, they can spin their narrative to make the company look great or look terrible. Let's look at the financial ratios. The average PE is 16.9, the median is 15.2. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 22.3, so investors are paying $22.30 for $1 of earnings. The average price of sales is 4.6, the median is 2.0. Price of sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. They're at 9.5, so investors are paying $9.50 for $1 of revenue. The average price to book ratio is 4.7, the median is 2.3. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. They're at 3.8, so investors are paying $3.80 for $1 book value. Equity is total assets minus total liabilities on the balance sheet. The average interest coverage ratio is 12.6, the median is 3.9. Interest coverage ratio is EBIT over interest expense, so they're at 2.7, so they can cover their interest payments almost 3 times. EBIT is earnings before interest and taxes. It's also called operating income on the income statement. The average ROE is 13%, the median is 12%. ROE is net income over equity. They're at 17%, so they're doing better than the median and average. The average current ratio is 1.8, the median is 1.3. Current ratio is current assets over current liabilities. They're at 9.2, so they can easily cover their current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables due within 12 months. Examples are current debt and accounts payable. If the current ratio is above 2, the company may be operating inefficiently. The company has a ton of cash relative to their current liabilities, $6.6 billion of cash. They probably could be doing more with the cash than letting it sit on their balance sheet. The best way to look at ratios is to compare them to similar companies. I've done videos on 9 companies in the same industry as Twitter, and Twitter's right here. If they have a number in red, they're worse than the average. If they have a number in green, they're better than the average. So in terms of price to earnings, they do have the best price to earnings ratio. The average is a little skewed because there's some company with big negatives in there. They're doing worse than average in price to sales, much better than the average in price to book. They have the highest current ratio of all the companies. Their average in ROE at 17%. They're a little higher in debt than average. They're a lot smaller in market cap because there's some really big companies in this industry, and nobody in this industry pays a dividend, so everybody's 0%. To summarize, I have them trading at a 127% premium. The ratios and financials look decent. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or just support the channel, you can click the link in the description below. Thanks for watching.